Look, I need to show you something that's been deliberately kept out of mainstream financial media. And once you see it, you're going to understand why the biggest banks on Wall Street have been fighting to keep this information buried. We're talking about a chart that reveals the single most important relationship in the precious metals market right now. A relationship that's been building pressure for over 3 years. And when it finally breaks, and it will break, we're looking at a price move in silver that could dwarf anything we've seen in the last 2 decades. But here's what makes this so urgent. The data I'm about to walk you through isn't some theoretical projection. This is happening right now. Real money is moving. Real positions are being taken. And the smart money, the people who actually move markets, they're already positioned for what's coming next. So let me ask you something. Have you noticed how every time silver starts to rally, it gets slammed back down? How it'll climb to $28, $29, maybe touch $30, and then suddenly, boom, it's back to $24 within days. You think that's natural market behavior? You think that's just regular supply and demand at work? Because it's not. What you're watching is the most manipulated market in modern financial history finally reaching its breaking point. And the chart I'm about to show you proves it. Here's what Wall Street doesn't want you to understand. Silver has been trading in an artificially suppressed range for years, while every fundamental factor that should drive its price higher has been accelerating. Industrial demand is exploding. Mine supply is declining. The deficit between what the world needs and what the world produces gets bigger every single year. And yet the price barely moves. But there's one chart that explains everything. One relationship that reveals exactly what's been happening behind the scenes. And more importantly, it shows us exactly what's about to happen next. I'm talking about the gold to silver ratio. Now stay with me here, because this isn't some abstract technical indicator. This is the Rosetta Stone of the precious metals market. And right now, it's screaming that silver is the most undervalued asset in the entire commodity complex. Let me explain how this works. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is sitting around 84 to 1. That means you need 84 ounces of silver to equal the value of 1 ounce of gold. But here's what's critical. Throughout history, this ratio has averaged around 15 to 1. That's the natural ratio you find in the Earth's crust. For every ounce of gold that exists in nature, there are roughly 15 ounces of silver. The market, over long periods of time, tends to reflect that natural abundance. So when you see the ratio at 84 to 1, you're looking at a massive distortion. You're looking at silver being valued at less than 1/5 of its historical relationship to gold. And that distortion didn't happen by accident. Let me take you back to March 2020. Remember that? The world was shutting down. Markets were in free fall. And the gold to silver ratio exploded to 124 to 1. That was the highest level in recorded history. You needed 124 ounces of silver to buy 1 ounce of gold. Think about what that means. Silver, an industrial metal that's essential for solar panels, electronics, electric vehicles, 5G infrastructure. Silver was being valued as if it was nearly worthless compared to gold. As if the Industrial Revolution never happened. As if we weren't in the middle of a massive technological transformation that requires silver in quantities we've never needed before. And what happened next? Silver went from $12 to $30 in less than a year. A 150% move. Because that ratio was so extreme, so disconnected from reality, that when it started to correct, the move was explosive. But here's what nobody's talking about. That ratio never fully corrected. It got down to about 64 to 1 in early 2021, and then it started climbing again. And now we're back at 84 to 1. We're back in extreme territory. We're back at levels that historically have preceded massive moves in silver. Let me show you why this matters so much right now. Gold is at all-time highs. Gold just broke through $2,700 an ounce. Central banks are buying gold at record pace. The World Gold Council just reported that central banks purchased over 1,000 tons of gold in 2023. That's the second highest annual total on record. So gold is doing what gold does. It's acting as a monetary asset. It's responding to currency debasement, geopolitical tension, and the slow-motion collapse of confidence in fiat money. Gold is working exactly as it should. But silver? Silver is stuck. Silver is trading like it's 2019, like nothing has changed, like we're not in the middle of the biggest industrial transformation in human history. Like the solar industry isn't projected to consume 85% more silver by 2030. Like electric vehicles don't require twice as much silver as traditional cars. This is the distortion. This is what the chart is showing you. Gold is reflecting reality. Silver is being held down. And that gap, that massive gap between where silver is and where it should be, that's your opportunity. Now let me tell you who's on the other side of this trade. Because this isn't some abstract market force. There are actual institutions that have been working to keep silver suppressed. And we know this because they've been caught. They've been fined. They've admitted to it in court. JP Morgan paid $920 million in fines in 2020 for manipulating precious metals markets. Not alleged manipulation, proven manipulation. They admitted to it. Their traders were spoofing the market, placing fake orders to move prices, then canceling those orders once the price moved. They did this thousands of times over nearly a decade. And JP Morgan wasn't alone. Deutsche Bank, HSBC, UBS, all of them have paid fines for precious metals manipulation. This isn't conspiracy theory. This is documented fact. These banks were actively suppressing silver prices while accumulating physical metal for themselves. And here's the beautiful irony. While JP Morgan was paying those fines, they were also building the largest private stockpile of physical silver in history. Between 2011 and 2020, JP Morgan accumulated an estimated 800 million ounces of physical silver. That's roughly 1 year of global mine production. They were suppressing the paper price while hoarding the physical metal. Why would they do that? Because they understood something that most investors don't. They understood that the paper market and the physical market are two completely different things. And they understood that eventually, the physical market would overwhelm the paper market. When that happens, the price discovery mechanism breaks, and whoever holds the physical metal wins. That's what this chart is really showing you. It's showing you the tension between the paper market, where banks can create infinite synthetic supply through derivatives and futures contracts, and the physical market, where supply is finite and demand is accelerating. And that tension is reaching a breaking point. Let me give you some numbers that Wall Street really doesn't want you to see. The COMEX, that's the exchange where silver futures are traded. The COMEX has about 300 million ounces of registered silver. That's silver that's available for delivery. Now, the open interest in silver futures represents claims on about 900 million ounces. So you've got 3 times as many paper claims as you have physical metal available to deliver. But it gets worse. Global silver investment demand was 329 million ounces in 2023. Industrial demand was 539 million ounces. That's 868 million ounces of total demand. And mine production? 830 million ounces. We're running a deficit. The world is consuming more silver than it's producing. So where's the extra silver coming from? It's coming from above-ground stockpiles. It's coming from inventory that's been built up over decades. But those stockpiles are finite, and they're shrinking. The Silver Institute estimates that visible silver inventories have declined by over 200 million ounces since 2020. This is why the gold-to-silver ratio matters so much. Because gold doesn't have this problem. Gold isn't consumed. Gold gets recycled. Almost every ounce of gold ever mined still exists in some form. But silver? Silver gets used up. It gets consumed in industrial applications where it's not economical to recover it. Every year, millions of ounces of silver effectively disappear from the market forever. So you've got declining supply, accelerating demand, shrinking inventories, and a price that's been artificially suppressed for years. And the chart, that gold-to-silver ratio, is showing you exactly how extreme this distortion has become. Now, let me talk about what happens when this breaks. Because we have historical precedent for this. We know what happens when silver catches up to gold. In 1979, the gold-to-silver ratio was around 30-1. Then the Hunt brothers tried to corner the silver market, and by January 1980, that ratio had collapsed to 17-1. Silver went from $6 to $50 in less than a year. That's a 733% move. In 2011, we saw another dramatic move. The ratio went from 70-1 in 2008 to 31-1 in 2011. Silver went from $9 to $49. Another 444% move. Both times, silver massively outperformed gold when the ratio corrected. Both times, the move was fast and violent. And both times, it caught the mainstream completely off guard. But here's what's different this time. In 1980, silver demand was primarily monetary. People were buying silver as an inflation hedge. In 2011, it was a mix of monetary demand and some industrial demand. But now? Now we're looking at structural industrial demand that's not going away. The solar industry alone is projected to consume 185 million ounces of silver annually by 2030. That's up from 140 million ounces in 2023. Electric vehicles are adding another 90 million ounces of annual demand by 2030. 5G infrastructure, medical applications, water purification. Every major technological trend of the next decade requires more silver, not less. This isn't speculative demand that disappears when sentiment changes. This is industrial demand that's baked into the infrastructure of the modern economy. You can't build solar panels without silver. You can't manufacture electric vehicles without silver. You can't deploy 5G networks without silver. So when this ratio corrects, when silver starts to catch up to gold, it's not going to be a temporary spike that reverses. It's going to be a sustained move driven by fundamental supply and demand. And the longer the suppression continues, the more violent the correction will be. Let me give you a real-world example of what this looks like. In 2020, when the ratio hit 124-1, something interesting happened in the physical market. Premiums on physical silver exploded. You couldn't buy silver coins or bars anywhere near spot price. Dealers were charging $8, $10, even $12 over spot for basic silver rounds. Why? Because the paper price said silver was worth $12 an ounce, but the physical market knew that was absurd. People who actually wanted to own silver, not trade paper contracts but hold physical metal, they were willing to pay $24 for something the paper market said was worth $12. That's a 100% premium. That's the physical market completely disconnecting from the paper market. And that disconnect is happening again right now. Go try to buy physical silver today. You're paying $4 to $6 over spot for basic products. That's a 20% premium on a commodity that's supposedly in oversupply. Does that make sense to you? If silver was really oversupplied, if the price really reflected true supply and demand, why would you pay a 20% premium to own the physical metal? You wouldn't. The premium exists because the paper price is artificial. The premium exists because the physical market knows something the paper market is pretending doesn't exist. And this is where it gets really interesting. Because the people who understand this, the people who actually move markets, they're not buying paper silver. They're buying physical. They're taking delivery. They're removing metal from the system. Look at what's happening with silver ETFs. The largest silver ETF, SLV, has seen its holdings decline from 572 million ounces in February 2021 to about 480 million ounces today. That's 92 million ounces that left the ETF. Where did it go? It went into private hands. It went to people who wanted to own the metal directly, not through a paper proxy. And look at what's happening at the COMEX. Registered silver inventories, the metal available for delivery, have been declining steadily. We're down from over 400 million ounces in 2021 to about 300 million ounces today. That's 100 million ounces that's been removed from the exchange. This is the squeeze happening in real time. This is the physical market slowly overwhelming the paper market. And the chart, that gold to silver ratio sitting at 84-1, is showing you exactly how much pressure has built up. Now, quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without tax penalties, and why that might make sense given everything we're talking about here. Worth checking out if that's relevant to your situation. Anyway, back to what happens next. Because the question isn't if this ratio corrects. The question is when and how fast. Let me walk you through the math. If the gold to silver ratio corrects to its historical average of 60-1, not the long-term average of 15-1, just a modest correction to 60-1, and gold stays at $2,700, that puts silver at $45 an ounce. That's a 70% move from current levels. But what if gold keeps going higher? What if gold goes to $3,000? That's not some wild prediction. That's a 10% move from where we are now. If gold hits $3,000 and the ratio corrects to 60-1, silver goes to $50. That's a 90% move. And what if the ratio corrects further? What if it goes to 40-1, which is where it was in 2011? With gold at $3,000, that puts silver at $75. That's a 185% move. Now, I'm not saying silver is going to $75 tomorrow. I'm saying the mathematical relationship between gold and silver is so distorted right now that even a modest correction produces extraordinary returns. And the longer this distortion persists, the more violent the correction will be when it comes. Because here's what people don't understand about market manipulation. It doesn't prevent price discovery, it just delays it. And when price discovery finally happens, it happens all at once. The market doesn't gradually adjust. It gaps. It explodes. It moves so fast that by the time most people realize what's happening, the opportunity is gone. We saw this in nickel in 2022. The London Metal Exchange had allowed massive short positions to build up in nickel. Then Russia invaded Ukraine, and suddenly there was a supply crisis. Nickel went from $25,000 a ton to $100,000 a ton in 2 days. A 300% move in 48 hours. The LME had to halt trading and cancel trades because the move was so extreme. That's what happens when artificial suppression meets real-world supply constraints. The price doesn't adjust smoothly. It explodes. And the people who were short, the people who were betting on continued suppression, they get destroyed. Now, silver isn't going to move 300% in 2 days, but the principle is the same. You've got years of artificial suppression meeting accelerating real-world demand. You've got declining supply meeting growing industrial consumption. You've got shrinking inventories meeting increasing investment demand. And you've got a chart, that gold to silver ratio, that's showing you exactly how extreme this situation has become. Let me tell you what the smart money is doing right now. Because they're not waiting for CNBC to tell them silver is a buy. They're not waiting for the ratio to correct before they position themselves. They're buying now, while the distortion is at its peak, because they understand that's when you get the best entry point. Look at what's happening in the mining sector. Silver mining stocks are trading at valuations we haven't seen since 2015. The average silver miner is trading at 6 times cash flow. That's half the valuation of the average gold miner. Why? Because the market is pricing in continued suppression. The market is assuming silver stays range-bound forever. But the smart money knows that's not how this works. They know that when silver moves, the miners move 3 to 5 times as much. They know that a 50% move in silver could mean a 150% to 250% move in the mining stocks. And they're positioning accordingly. I'm seeing institutional buying in names like First Majestic, Hecla, Core Mining. These aren't retail investors chasing momentum. These are funds and family offices building positions while valuations are depressed. They're looking at the same chart I'm showing you, and they're reaching the same conclusion. The distortion can't last. The fundamentals are too strong. The supply deficit is too real. The industrial demand is too structural. Something has to give. And when it does, the move is going to be spectacular. Because silver has been coiled like a spring for 3 years. Every time it tries to rally, it gets pushed back down. Every time it builds momentum, it gets hit with a wave of paper selling. But that selling is getting less effective. The physical market is getting tighter. The inventories are getting smaller. The deficit is getting bigger. You can see it in the price action. Look at how silver responded to the banking crisis in March 2023. It spiked to $26, then got hammered back to $22. But it didn't stay there. It recovered to $25 within weeks. Look at how it responded to the Middle East tensions in October 2023. Same pattern. Spike, hammer, recovery. Each time, the recovery is faster. Each time, the base is higher. Each time the market is showing you that the underlying bid is getting stronger. The physical demand is overwhelming the paper suppression. And the chart, that gold to silver ratio, is showing you that we're reaching the end game. Because gold is at all-time highs. Gold is doing what it's supposed to do. Gold is reflecting the reality of currency debasement and geopolitical chaos. And silver is about to catch up. When it does, the move is going to be fast. It's going to be violent. And it's going to catch the mainstream completely off guard. Because they're not watching this chart. They're not tracking the supply deficit. They're not paying attention to the inventory drawdowns. They're going to wake up one morning and see silver up 15% in a day, and they're going to scramble to explain it. But you'll know exactly what happened. You'll know that the distortion finally corrected. You'll know that the physical market finally overwhelmed the paper market. You'll know that the most manipulated market in modern financial history finally broke free. And if you positioned yourself before that happened, if you understood what this chart was telling you, you'll be sitting on gains that most people thought were impossible in precious metals. Because that's what happens when artificial suppression meets real-world fundamentals. The fundamentals always win. Always. It just takes time. And the longer it takes, the bigger the move when it finally comes. So here's what you need to understand. This isn't about timing the perfect entry. This isn't about waiting for confirmation from the mainstream media. This is about recognizing a historic distortion and positioning yourself before it corrects. The gold to silver ratio at 84:1 is telling you that silver is the most undervalued asset in the precious metals complex. The supply deficit is telling you that the physical market is getting tighter every day. The inventory drawdowns are telling you that the available supply is shrinking. The industrial demand projections are telling you that consumption is about to accelerate dramatically. Every single fundamental factor is pointing in the same direction. And the chart, that one chart Wall Street doesn't want you to see, is showing you exactly how extreme this opportunity has become. The question isn't whether silver is going higher. The question is whether you're going to position yourself before it does. Because once this move starts, it's not going to wait for you to get comfortable. It's not going to pause so you can do more research. It's going to move fast, and it's going to move far. And the people who understood what was happening are going to capture gains that seemed impossible just months before. This is the opportunity. This is the chart. This is what Wall Street has been hiding. And now you know exactly what it means.